Good morning, everyone. Thank you for joining us today for the From Risk to Revenue webinar, Smart Credit Management with DebtorLogic. My name's Dominic D'Andrea. I am a manager here at CreditWatch, been with the business for 7 years, and I will be hosting the webinar. It's going to be a 30-minute webinar. We're going to have a couple of poll questions, and at the end of the webinar, there's going to be a little bit of a treat for everyone that's joined. So please make sure that you stick to the end. Just while we're waiting for people to join us, we actually have a poll question. So the question today is, how confident are you in identifying customers at risk of default before it happens? So we'll let you fill that in. While we're waiting for people to join, I also have Adam Sanfilippo, who's a National Credit Manager of Car Sales. Later on in the webinar, he's going to be sharing how Car Sales actually use the tool. So looking at the poll, it's in, we've got 10% very confident, 30% somewhat confident, and 60% not confident at all. So you're all definitely in the right place. With that being said, let's jump into the webinar. So, a bit of an agenda. So the first thing that we're going to go through is why predictive analytics matter today. That's probably a key point to start off with. Managing risk at scale, then best practices from our industry peers. That's going to be where Adam from Car Sales will join us, and then practical next steps to implement portfolio level insights. So why predictive analytics matter? This kind of graph speaks volumes. What we're looking at here is companies entering insolvency for the first time as at the 30th of June 2025. So key stats here, there's been a total of 14,716 businesses that became insolvent in FY25. That's a 30% year-on-year increase. The majority of those businesses fit into the hospitality, construction, and other services ANSIC code sections. So if you're in one of those sectors, they are the most at risk, and those are the businesses that have gone under. Now, this kind of sets the scene to kind of help everyone understand that things are getting more risky, more businesses are going under. We obviously know that there's a lot of different pressures happening across the market, and there's kind of this knock-on effect. If people have less spending power, there's going to be less investment into property, maybe people are going out less, and there's kind of a knock-on effect to other industries. So really today, what we're trying to look at is how we can address these issues in a more proactive way. So the first thing that's important to understand in terms of why predictive analytics are important is history doesn't repeat itself, but it rhymes. So what we're saying here is looking at the past will help us predict the future, predict the future, but give us a better idea of what could happen in the future. And that allows us to plan better. So what are some of those elements? So the first element that we're going to look at from a credit perspective is credit policy. Just the basics. Who am I going to give terms to? What are those terms, and when should those terms change? So am I giving someone terms in the first place? Is it 14 days? Is it 30 days? Am I putting them on COD? Do I start them off with a smaller limit, maybe $5,000, and then let them build up some trust and then give them those larger accounts? So it's really about understanding our customer base and building really strong policies around that, which will help us be proactive, which is the next section. So by being proactive, what we're saying is we've got a really clear structure on who we're going to deal with, why, and how. And having that structure then allows us to look at things like alerts. So what alerts require what actions? What happens if a customer goes from let's say, for example, a C1 or C2, which is the average risk for a PTY Ltd operating in Australia today, down to, let's say, for example, a D2 or a D3, which would be a high risk customer. Should they be put on stop? Do we need to reduce their terms? Do we need to kind of be more proactive in our collections activities? Those are some of the questions that might raise. So how do I de-risk my current customer base? Looking at how that risk is spread over your customer base then allows you to implement policies and procedures to deal with those customers. And then lastly, how do I grow low risk customers? We know that as part of business, most of our revenue comes from our existing customer base. Why aren't we focusing on those good customers who always pay us on time, that pay the rest of the market on time, and there is the opportunity to grow in a safe, long-term manner with those businesses? And also just keeping an eye on those low risk businesses, sorry, those high risk businesses, and making them go through the steps to try and get them to that low risk kind of customer base. And then the last piece on this slide, reducing risk. It's really important to understand from a dollar perspective, are my customers using me as a bank? Now, the question around this is, do they have the cash to pay me, but they're prioritizing paying someone else? And if they are, what can we do to try and change some of that behavior? And then finally, how do I manage a large volume of small dollar customers at scale? Sometimes it's really, really hard to gain efficiencies in that area. If there's $100 outstanding and you have to send, 20 emails, make 10 phone calls, et cetera, it kind of starts to make that exercise really not a really good return on your time investment. So what can we do in order to try and manage those customers at scale and put some automated processes or at least standards in place? Again, if there's any questions on this, please ask those in the questions section. I might stop here because we also have another poll question here. So understanding audience maturity. The question here is, how often do you currently review your aged receivables to assess risk? Is that weekly, monthly, quarterly, rarely, or never? Oh, interesting. Weekly. That's a very good cadence. 60% weekly, 20% monthly, 7% quarterly, and 13% rarely. So we'll kind of have a bit of a look in the next couple of stages of what managing risk at scale looks like with DebtorLogic, and then we'll actually go and have a quick look at the tool as well. So we asked some questions in that previous slide. So what are the answers? So the first thing that we're going to look at is live risk ratings. So mapping out the dollar value to predict the default rate in real time with ATB uploads gives us a real-time exposure to our customer base. So we're not kind of putting our finger up in the air and trying to guess. We actually have some real data that kind of backs up our decision making, which is really, really important when we're having internal conversations with different stakeholders and different teams. Sometimes a lot of the credit process is kind of based on gut feel and experience, but being able to back that up with some real data is really powerful when we're talking to other parts of the business. Dynamic risk filters. What we're looking at is, well, how do we actually manage the data? What are the key things that we're looking for? So are we able to look at the forecasted default rate? That's going to help us with our kind of cash flow analysis, working capital, all of that fun stuff, DSO trends. Are we managing our days outstanding? So if we don't measure, we can't manage. So how are we sitting today? Where do we want to be tomorrow? And how are we going to do that? Payment behavior, looking at how your customers are paying yourself and the rest of the market. Exposure size. So really important to understand if someone owes you $100 and there's maybe an ATO default against the account, but there's also another business that might owe you $50,000 with an ATO tax default, the priority is going after that larger business, and there's some more things that we'll also show you. And in prioritization, so I just mentioned it there, but focusing on risk versus age. Traditionally, we kind of normally work 90 days backwards. We're looking at the oldest outstanding invoices, and we're trying to collect those first, when really we should really be focusing on at risk. Is that money going to be there tomorrow in order for us to collect it? Sometimes you might have some larger businesses that might pay you a bit slower, but that's the cost of doing business with them. But really we want to understand, is that money at risk, and will we be able to collect it? So identifying who can or can't pay you. Again, in terms of cash flow forecasting, that's going to be really important there. And then what does a good customer look like? If we can identify what a good customer looks like, that's really going to help us in our overall kind of credit policy in terms of customers that we're going to onboard and do business with. And that kind of standardized framework will then help us grow faster. So next we're going to have a look at DebtorLogic live in action. I've actually got it up here on another screen. So DebtorLogic, just so we understand, is a tool that allows us to analyze our aged receivables in a number of different ways. I won't go through the whole tool, but I'll focus on a couple of key areas. What we're able to do here is basically mix all of CreditorWatch's analytics as a bureau, all of our data points, and then mix that with your age receivables and make it more relevant and impactful for you and your teams. Not just looking at risk, but also looking at risk associated with dollar value. So the first area that we're going to look at is risk category. So here in this example of an ATB that's been uploaded into the system, we can see a clear breakdown of different risk flags and the dollar value associated with those risk flags. The really nice thing about this tool is it actually allows us to go in here, click and drill down into who these specific customers are. So going back to the risk category, we can see here that we've got a couple of different risk flags and the dollar value associated with them. What we're looking at here is what do I need to action first? So in this example, we can see that there's external administrations, there's ASIC documents relating to administrations, and voluntary registrations and strike-off actions. Those are all things where potentially that money that's outstanding might not be there tomorrow to be collected. So as in terms of prioritization, we might want to look at collecting in those areas first. We've also got an example here of tax defaults and dollar values outstanding there, which is some critical risk. So you can see that by analyzing the tools, not just on risk, but risk and dollar value, we're able to prioritize our collections efforts and our analytics in a much more effective way. The next area that I'm going to look at is the customer insights. This table shows us how our aged receivables are being compared to the rest of the market. So where does this information come from? So we link into Xero and MyOb for our smaller customers. So if you're a Xero or MyOb user, there is actually a free integration into our debtor management tools that I encourage you to use. And then for our larger customers, they actually provide us with aged receivables and as part of using this tool. So what we're looking at here is these are the average days overdue aggregated from our trade lines that we collect from across the market, and this is how those your customers are paying you. So in this top corner, what we're looking at is customers who are paying you late, 60 to 90 plus days, but they're paying the rest of the market current and 1 to 30. We can see here that there's nearly $400,000 potentially of low-hanging fruit that from a cash flow perspective, these customers are using you as a bank. One of the things that's really interesting to kind of understand about the world of credit management that sometimes other functions of the business don't understand is we're kind of operating a little bit like a bank. We're kind of giving out loans to people really with 30 or 14 days or even longer terms to pay us back. Really, if we were a bank, what are some of the criteria that banks have in order to lend you that money? They're going to ask for a whole bunch of additional information in order to support that loan. But when it comes to the credit world, we're not as robust in terms of our assessments because obviously the necessity is to kind of do business. But what we're able to look at here is that if customers are paying other people on time, we have to ask the question, why aren't they paying us on time? They have the cash to pay, or they should have the cash to pay, but they're prioritizing paying someone else. So I could double click on this square and it would identify who those customers are for me, and I could prioritize my collections to go after those businesses. This bottom corner looks at people who are paying you late and the rest of the market late. This is probably stuff where you might not be able to recoup those monies, but it's really important to understand that these are businesses that you probably don't want to deal with. Interesting here is if they're paying you on time, but paying the rest of the market on time, that current and 90 plus days, this is probably a lead indicator of businesses that are struggling to pay their other suppliers, but you might be a critical supplier, maybe a tier 1 or tier 2 in order for them to operate and run their business. It's a really good lead indicator that potentially they could be starting to struggle and you might want to reduce your exposure. But it's not all bad news. We're also able to identify who those low risk customers that I mentioned before are, looking at growing those businesses who are paying you and the rest of the market on time. The next section that I'm going to look at is the risk analysis. This allows us really to kind of have a more informed, holistic view potentially of our overall customer base. We're looking at, again, aged receivables against risk. So what we're saying here is that the lower the risk, even though they're paying you late, they are more than likely going to pay eventually. It's just a question of when. Like we mentioned before, some of those larger customers, it's just the cost of doing business. But when we're looking at these lower high risk ratings, which are the Ds and C3's potential risk, we're starting to have to assess whether these customers are good customers and we want to keep them on their current terms. One of the things that's really important to understand is day one, when we onboard customers, we're obviously doing credit checks and reports and maybe using our onboard tool, Apply Easy, to check their risk rating in that point in time. But what happens 2, 3, 6, 12, 24 months down the line? That's where there's a bit of a gap currently in most credit management processes. It's the ongoing management of customers. This screen allows us to, first of all, understand, analyze, and create our credit policy, but then it allows us to manage and enforce it as well. So for example, if I was a business that didn't want to give terms to customers that were Ds, and I onboard customers at C2, they might eventually creep into this section. I'm able to look at that at scale and kind of obviously empower my team to make the changes that they need to in order to de-risk my portfolio as much as possible. An interesting one that we also see on this graph is Fs. Unfortunately, Fs are businesses that have gone under. We see this a bit where you might have, they're paying you currently, but they're an F. What we see a lot is businesses shutting down, selling, new owners taking over, but they don't always communicate that to their creditors. This also allows us to identify who those customers are and then proactively reach out and make sure that we have agreements in place to make sure that we're not exposed from a contractual perspective. The last section that I'll talk through is the actionable section. So like I showed you before, all of those different graphs, you can drill down and click into them to identify who those entities are, but we also are able to extract the information to make it practically applicable. It's not just an analytical tool, but it's also a tool that allows you to proactively take action. So let's say, for example, we want to look at that bucket where customers are paying us 60 to 90 plus, but average days overdue, they're paying people current 1 to 30. So this is a list of all of those customers that fit into that bucket. This is a great list to look at from a cash flow perspective. Let me try and prioritize collecting money from these customers because they have the ability to pay us. Or one of the other examples that I gave before was looking at risk categories. So let's look at companies that are under external administration, voluntary deregistrations, and strike-off actions in progress. We're able to also create that list and have an effective list of customers that we need to go through and have a conversation with, maybe change how we're doing business with them. So that's a little bit about DebtorLogic. We'll go back into the presentation. And next we have Adam. Adam, thank you for joining us today. Adam is the National Credit Manager for car sales. Like I said, Adam, thanks for joining us. We've got a couple of questions here.
Yeah.
So, Adam, how do you typically integrate DebtorLogic insights into your credit decision-making process, including risk? How does car sales currently do that?
Yeah, well, as you sort of said, we get an age trial balance, which I actually load up twice a month because DebtorLogic works as good as the information you give it. So the more, as often as I put it up, which is twice a week, twice a month, it means that the information I'm getting back from DebtorLogic is current. So that's the first thing. Get the information in there, so I've got the right information. But from that, I'm able to then determine which customers are paying us later than other customers, and then I can actually then suggest to the team, okay, these are the type of customers that we want to focus on and find out, why they're doing that. Clearly they've got the money, as Dominic, as you said, potentially they've got the money. Is it just a case of we haven't been on the phone long, quick enough, and they're paying someone else who's getting on the phone early? So therefore, we change our strategy. We get on the phone quicker and get that money in. But I'm also able then to also it gives you the credit score. From that, you get your credit scores as you from A1 all the way through to F, preferably not an F. You don't want to see them, but those ones that you get between sort of C1, C2, and all the way through to D3. They're the ones from the report I'm able to then target, and they're the ones we do target because they're they're a risk. So we want to make sure that we're on, one, they're not using us as a bank if they got the money. Two, potentially, and especially with small business, there'd be cash flow issues. We want to get on top of it and find out, what's not only collect the money, but what's the case, what's going on with that. So with, as I said, with the DebtorLogic, it enables us to really hone in on specific, rather than just getting our reports and, looking into the brackets of 30, 60, 90, we can actually hone in and find out, right, where are the specific areas that we can focus, get quick wins from a cash flow, or even better, identify ones that we probably need to not only rein in the money, but then probably consider how do we then deal with them going forward. Do we continue with them? Do we put them on direct debits? And that's what we do, using those grading, particularly C2, C3 up. We then determine, they usually end up being our small to medium businesses. We then determine, go, right, we're going to put these customers on direct debit, and this way it gives us a bit more control from that. Yeah.
Also, it allows you to do the analytics at high level, then kind of create a more targeted list to carry out the kind of day-to-day actions. That takes us nicely onto the next question. So what kind of ROI or efficiency gains have you seen since adopting DebtorLogic?
Yeah, the simplest one, and I'll go in more detail, the simplest one is the DSO. In the last, I've been with car sales almost 5 years. So it's probably has come down between 12 and 14 days in that time. And that happened really early on, within that first year that we used, that I was here and used DebtorLogic. So it played a big part in making, and obviously you've got your own processes and procedures, but DebtorLogic really played a big part for because of what I mentioned before. You were able to pinpoint which of the customers that were probably just sitting there and we weren't doing much about it, but this allowed us to really get focus on that. So it was so that and it's also been identifying customers with poor ratings. So that allowed us to go back to our sales team, and anyone who works in AR knows how hard those conversations with the sales teams are, because they're not necessarily, they got to sell and they don't necessarily understand our end. But working with the sales team and saying, these are real risks. I know you've sold it, so to speak, but we don't consider it sold until it's paid. So you need to understand what we're seeing. So getting them involved. So, but that's where it's been a real benefit that the DSOs drop, but also the change in attitude with our customers. They realise they can't use us as a bank. We want our money. Roughly when it's due, and they need to be. If they are struggling, they've got to get in touch with us. So that's what it's done. It's actually identified these are the group of customers we need to spend more time on. So yeah.
That's awesome, Adam. So having that kind of data has allowed you to communicate effectively to the sales teams, where previously they were, just trying to sell. Like you said, the deal's not sold until the kind of money comes in, but sometimes it's hard for them to see that side of the coin. So this data has helped make that picture a bit clearer for them.
Yeah, and in that first year that I was here, we used to have fortnightly meetings with the sales team, which they soon didn't want to do. But I actually showed them DebtorLogic along with the debtor ledgers and showed them this is why. So they actually get to see it's real. It's not just us.
That's really
talking
cool.
So they actually see it and go, okay, I get where you come from. So yeah.
really great, Adam. And do you have an example of where DebtorLogic helped you avoid a potential bad debt or a credit risk?
Yeah, yeah, yeah. It happens quite often. We get the alerts. We get alerts, and one of the good things about the alerts, and I've worked with Dominic about this to get it more. You can get the alerts to suit what you need in your own industry. And for example, there was a period there between sort of March and June this year. We're getting a lot of alerts relating to ATO debts. Look like the ATO is really coming down on a lot of businesses and all that. So I was getting a lot of accounts, new accounts to set up, and for me to check where they'd have an ATO debt, and excessive amounts. We're talking in excess of 50 to 100K. And obviously I would reject it, and then obviously the customer and the sales team would want to know why, and and then the customer would have their reasons, and the good thing about it was that that it allowed the customer then to tell us the truth. They realised then that we had information, and because initially we get, it's just that I've sorted that out. They made a mistake, and that was that. I was like, well, no, that's not good enough. I'm not accepting that. I want some details. Why? What have you resolved it? How did you? Can you prove it's been paid and settled? And in almost all cases, they couldn't, because it was just talk. So it allowed us then for me to make a decision to go back to our team or the sales team and go, this customer's not coming back. He's not coming on. So you have to find another way, whether it's COD, whatever, but you have to find an alternative. And also the other side of the customers, that existing customers that we find out through the DebtorLogic that they've got an ATO debt, I then quickly get the team on the phone, tell the customer what we know, and if it's going on hold. Again, obviously that causes the customer to call and email, and but we almost always justified on putting it on hold, because again, eventually we find out they do have a debt, they're on arrangement with the ATO, and we then we stop the sales, we collect the debt, try to get the money that we're owed, and then we tell the sales rep, I tell the sales managers to reduce or stop their sales to the client. So and that's sort of and then we put those customers, if they want to come back on and they have paid, we then put them on a direct debit, so we got better management. In fact,
it's really good to hear how there's kind of real practical implications of using this, and you're able to kind of manage and stay on top of it at scale. But also you mentioned from that kind of initial phase of onboarding customers and having those conversations with sales.
Yeah, absolutely. Yeah, it plays a big part, because especially it's only about an hour before I had this meeting where I had a meeting about putting more customers on direct debit, and I was asked how we're going to identify those customers. Now, one part of it is our debtors report, and we go for our smaller dealers. But the other component I said to them is that I need to then go through those dealers on DebtorLogic, find out their credit scores, and anything that's over, well, I think we said C3, but for starting point anyway, anything over C3, they're automatically going to get a communication about, we're moving you over to direct debit, because of the conduct, how we're going to word it, and then based on that, obviously we're going to get not the response. The customer's not going to like the response that we're giving. So then we have those conversations with the customer. It allows us to then go, right, we've identified your account is always is consistently in arrears, and you need to come into terms. But DebtorLogic allows that to identify. So it's a two-part. You can get your debtors list, but the DebtorLogic allows us to go, these are the customers we go first, because they're at risk. We'll start with them and then work your way.
Awesome. Thank you, Adam. That's some really great examples of how it's practically being used. We've got 2 more slides left. I know we're kind of going a little bit over time here, but one little kind of shout out is for some of our larger customers. Basically, the requirement here is for over 5,000 customers. But what we're able to do is build custom risk scores, mixing your data with our data and a specific algorithm based on your requirements. It's basically effectively creating your own personalized credit bureau for your business if you wanted to go another level deeper of using your age receivables to help your business. This helps with doing credit limit increases, shadow limits, all of that kind of stuff, which will really help manage customers at scale. And the last bit for all of those customers that stayed on, like I said at the start, we've actually got a little bit of a special opportunity here for our customers. We're doing a free age receivables analysis for all of our webinar attendees. So if that's something that you're interested in, you're able to reach out to your account manager. We have a template of how we need the data to look, and then we'll be able to upload that. Thank you everyone for joining us today, and we hope that you got a lot of value out of this webinar. Thank you and enjoy the rest of your day.